Example. 1 second. So let's take an example how we transfer risk. Let's see you are uh, holding a lot of as in lot of shares of a given security, maybe ICICI Bank. You've got a complete lot which is listed in the futures and options market, right? And now you have a fear, though the first thought which you have is the share price of a given stock is going to rise over few months or so, or maybe a month's time. Now at the same time you have another thought which says maybe the value may also go down. So this is another thought that you have now uh, to manage your risk, or to transfer the risk of not transfer to losing money. What you can do, you can buy a put option. What put option would do, put option is essentially transferring the risk that you have on the equity by way of its value reducing, right? So then the put option would be activated, and it would recover your loss, or it would mitigate your loss in a sense, right? So this is how you can trade risk, or you can transfer risk with the various options available in the financial world. So you have those options by which you can transfer risk, or you can shift risk to the other parties. And then when you do that, or when you plan to do that, you certainly going to assess the cost involved into it, because nothing is free, as we know. So when we say you're going to buy the put options, the put option will cost you some amount, and what that amount would be is something you are going to assess, right? And you need to be very careful about the fact, like there would be some cost involved into all this risk management. And if you are ready to bear that cost, then you would be mitigating or transferring that risk in that manner. However, if you don't want to do that, then probably you are going to take or absorb that risk in a sense. So if you're not transferring the risk, so you are bearing the risk, or you are absorbing the risk if something goes wrong. So that is how the approach would be considered, right? So the form of mitigation strategy which are given there: avoid, transfer, mitigate, keep. So keep is the one where you're not taking any action. You know, you are cognizant of the fact that there are risks, but still you're going to keep them. You don't want to transfer them. You don't want to trade them, right? And you don't find any other control mechanism to manage them, right? So that then that way you would say you're going to keep the risk with you, and then you evaluate the performance, how it is doing. So that in the financial world, you can definitely look at the profit and loss, and you can evaluate how your risk, which is there in the system of the process, is doing, right? So that is how it is. Yeah. Any question as of now? It is clear.
Yes, sir.
Okay. Okay. So moving on. So risk management is how firms actively select the type and level of risk that it is appropriate for them to assume. Most business decisions are about sacrificing current resources for future uncertain returns. Risk management and risk taking are two sides of same coin. Together they drive all our modern economies. The capacity to make forward-looking choices about risk in relation to reward and evaluate performance lies at the heart of management process of all enduringly successful operation, right? So risk and reward are two things which which are looked at when you talk about the risk management as a process. So while you are mitigating the risk, the reward piece will be reduced. However, if you take the more risk, the reward would equally be high, or risk would also be high. So that way you can say the risk management and risk taking are the two sides of the same coin. Because when you do the risk management, you are basically, what you're doing, you are one side when you're reducing the risk, right? So you're also reducing your rewards, right? So that is why it is written, it's a two sides of the same coin. So reward and risk go hand in hand. Reward increases when you are taking more risk, and similarly the risk increases when you're taking more risk. So it is directly proportional to each other. Okay, so that's how all different kind of risks that we know are these: market risk, credit risk, liquidity risk, operational risk, regulatory, legal, business risk, strategic risk, reputational risk. So all these risks we'll talk in the subsequent slide one by one, right? So this is the agenda for today's discussion. So these risks we're going to talk in the subsequent slide one by one. Okay, so I see now nine people have joined. Ajay is there, Akash, Chankri, Nishant, Rahul, Sana, Shreya. Okay. Yesterday, I guess the number of people were more, or maybe same. I don't know. Okay, no worries. So let us continue, and if more people join, they can join. Okay, so these are the risks that we're going to talk in the subsequent slide. All these risks which are listed there on the slide: market risk, credit risk, liquidity risk, operational risk. Okay, let's come to the next slide. What is market risk? How would you define market risk? Anyone? Anything that
The
you
the
can?
market risk
Market for
is the risk.
Yeah, go ahead. And one by one. Yeah, yeah.
the
Go ahead.
market risk may be falling in equity share price rate, means maybe falling
Hmm.
of the market,
Yeah.
or in the
Right.
day in the bond segment we can say that interest rate may be fall.
Hmm. Right.
Um, these are
Correct.
the market.
Right. Yeah.
So the market risk is the risk which is due to the change in the demand and supply
Hmm.
of the share prices, or demand and supply of the
Yeah.
equity commodities. So
Right. Right. So as a word market, when you link market with risk, so it is coming from market, right? So if something happens in the market which um, creates a problem in the various instruments traded in the market, so that kind of a risk would be considered to be market risk. So like the interest rate risk, so when the interest rates are increased, what will happen? The demand for the bond will reduce. We know the phenomena, the relation between the interest rate and the bond price, right? So how they behave. So if the interest rate increases, the bond market will have an impact. So the existing bond would be traded below its fair value, right? And therefore the bond market would be impacted, right? And similarly, if the equity price are, if there is any some market risk of the nature wherein the COVID can be also one of the example of the market risk, right? There is something which is the external factor, right? Which you cannot time, which you cannot fully control. So something which is originating or which is coming from the market. So that kind of a risk would be the market risk where you don't have any control over, right? So that kind of a risk would be, so it can be your equity risk, it can be your interest rate risk, foreign exchange risk, or commodity risk. It will impact everything, right? Then of course it is going to impact your trading also. Trading risk would be there when the market risk is there, when the market are not conducive for the various activities, so the trading will also not be conducive, so you would not be finding trading so uh, it can have some biases. When I say biases, that means when bearish market is there, so the trend that bearish trend would favor one side clearly, right? So that kind of trend is not good, right? So there should be a balance in the market so that it's a good trend. If it is like in this scenario, the COVID scenario, when the market was just falling, so it was a one-sided market, right? It was not two-sided market, so it was just bearish market. People were just pulling out the money. So that kind of market is not that kind of market is not a good market, right? So that is a market risk, you would say, and if that is a market risk, or trading risk would definitely be there. People would not like to park their money in stock. They would like to pull out their money, and therefore the trading significantly will reduce, right? And so there is a trading risk. What is gap risk? Gap risk, any idea if you have heard this gap? Okay, so gap risk is gap down and gap up, right? So when it is related to trading only. So when there is a risk in the market, right, and the markets are riskier, so you will that risk will be reflected in the market as in it will be reflected in the trading, and trading will have a gap down and gap up opening. So gap down means it can be all of a sudden there will be a huge slide in the stock prices, huge slide at one go. So market is opening with a gap down. So on a regular basis also, when you say especially the Indian Nifty or Indian market, you can say it copies the SGS Nifty, Singapore Nifty, right? So if the Singapore Nifty is opening a gap down, similarly the Indian market also mirrors the same, and it also opens with the same gap down most of the time. It is not something which is the thumb rule, but it is that it is a bit of a mirroring happens in the Indian stock market also, and that is what the gap risk is all about. So gap, it can be gap up, it can be gap down, which both ways you can say when there is a market risk, right? So general market risk is when it is impacting the entire market. So then this is the general market risk. When a specific risk is specific event which could be related to a particular stock, that can be wherein the management is not doing good, the company is not making profit, or a company does not have a long-term vision, company does not know how to use the surplus profit, and there is something bad happening with the company, right? So that can be related to the company's internal matter, which is not liked by the stakeholders. So that kind of a risk would be specific risk. So it can be related to stock, can be related to the other thing also, right? So any specific risk, that is how you would categorize it as specific risk. Like then you look at the other risk, which is credit risk. Credit risk can further be defined as it can be at the portfolio level, it can be at the transaction level, right? So credit risk uh, is when you say the portfolio concentration, if you've got the same kind of a trade from the counterparty or from your client, so there is a possibility of a bigger risk, because when you have got the same kind of securities or same kind of trade, when I say this as in the same securities with you, so there is a possibility wherein you are having the concentration risk, and if that particular given security goes down because of losing the credit rating it has, so there is a possibility you're going to lose a large chunk of your money. So that is a credit risk in a sense. Then you have issuer risk, counterparty credit risk. Counterparty credit is simple to understand. You have given a credit to the counterparty, and now you fear the counterparty would be able to return that money back to you. So that is the counterparty credit risk, right? Issuer risk is when the issuer is issuing some security and issuer is defaulting. So right, so that is a issue risk. And issue risk is when you're coming of the IPO or FPO for that matter, and the entire issue is not fully subscribed, right? So that is a risk on the issuer, or that the issue risk you can say, because a lot of money is involved into carrying out the IPO, and if the IPO does not succeed in its mission, then it is an issue risk, right? So that is how you would define these terms which are given there. Okay, any question as of now, guys? All fine? These are
Yes,
simple
sir.
simple key terms, but we should have some knowledge about these terms so that you don't go blank in the interview. You should have something to talk about, though the information given in the presentation is not very complex, it's simple to understand. But uh, the idea is we should because the complex information cannot be given, and complex information when we go, that is more technical in nature, so that we cannot talk with this presentation, because otherwise if you look at the risk, the risk management, those FRM and all those things, so those have a lot of numbers and valuation and all those stuff. That is what is this is not that is not the agenda of this particular topic. Right now the agenda is to understand the terms that we have. What is credit risk, what is equity risk, what is interest rate risk, all these terms, the final terms that we have, that you should be knowing, so that you don't go blank in the interview, you have something to talk about. and the fundamental stuff should be clear to you. That is the whole idea about this presentation, and that is why I'm saying this is, you know, this is one topic which is easy to understand. There is nothing as in difficult terms involved here. Okay, so let us move on 1 second. Now on building on the same concept that we just did, so it is just a bit of a, you know,
Sir, your screen is not visible, sir.
screen. Oh, is it not? 1 second.
Yes, sir.
1 second. Let me just try to share it again. Let me stop it and then try to share it. Let me know if it is visible now.
Yes, sir. Now
Okay.
visible.
Okay, fair enough. So let us move on. And okay, market risk, again building on the same that we just did in the previous slide. The market risk is the risk that changes in financial market prices and rates will reduce the value of the security of the portfolio. So this is coming from the market. As we know, you can't time it, you can't, you know, control it. So that kind of a risk which is coming from the market, right, and which can change the value of the portfolio, which can change the value of your stocks, which can change the value of, you know, the various securities you have with you. So that sort of a risk would be categorized as a market risk, right? So that can further be divided into general market risk component, specific market component. So specific, as I said, is related to a given stock or given security that you have. So if something bad happened with that particular security, so that risk will be reflected in your security by having its value reduced, right? So that would be reflected if the given company is not doing, like Satyam was one of the company, and when this accounting scandal happened with Satyam, so the stock of the Satyam fell very badly, right? So that is just related to a particular stock. So if it happens with the, if it, and you would remember some similar stuff happened with Infosys, wherein there was some allegations on the CEO of the company uh, back in the last year or maybe before, and you know, then the stock value also uh, fell in some, you know, some percentage, and that remained down for some time. So that is specific market risk component, and general market risk component is wherein it is difficult to find out. It is more of the market approach, where when, like you know, the when this news comes, Fed is tapering in, right? And so this kind of a news actually make market more volatile, and there you see the market market responding in that manner. So market, when I say market responding, so you find um, FIs or big player pulling out money when they see a news of this kind, right? So this is a general market risk component, wherein the entire market, you can say, or all the stocks which are there reflect some degree of reduction in its value. So that would be called a general market risk component. However, when you see, there is some specific market risk which is specific to some, you know, certain sector or certain areas of the market, which can be commodity, which could be FX, which could be, you know, or maybe a given stock only. So that would be considered to be specific market risk component. Okay. So this is how it is. In trading activity, risk arises both from the open, unhedged positions and from the imperfect correlation between the market position that are intended to offset one another. Right. So in trading activity, we know the, if you're not hedging a position, you're going to bear the risk, right? And similarly, if you are taking if not, if your portfolio is not diversified, then also they're going to be risk, right? So when you say imperfect correlation, what does it mean? It basically means you having and you are having same kind of securities. If the same kind of securities you are having, and if there is a risk in the market, so those securities would lose its value. And if you are having a good correlation, when you say good correlation, basically you have a diversified portfolio, wherein if one thing goes down, the other market supports you, and that way you are able to maintain the value of the portfolio. So that is a good correlation is all about. Okay. Okay, now what is interest rate risk? Interest rate risk, you would be understanding largely because we have covered this in the bond chapter also. Interest rate risk is where the interest rate either are reduced or increased, right? So when this happens, so that would be reflected in the market also, right? So the fixed income security will fall in its value when when the interest rate increases. Similarly, when the interest rate decreases, the bond securities, the bond, as in this bond securities will increase in its value. So that is your interest rate risk is all about. Equity price risk. This is the risk associated with the volatility in stock prices. General market risk of equity refers to the sensitivity of an instrument or portfolio value to change in the level of broad stock market indices, right? So general market risk we have already covered. So it is again given there. So it is basically when there is a market risk when the entire market is going down. So irrespective of which stock you are holding, there would be some reduction in its value. So that would be your general market risk, because the entire market is responding or reacting in that manner. So even your stock would also be reflecting the same thing. That would be a different matter. It might not be reflecting exactly the same level of reduction which the index is reflecting, but there would be some degree of change in the value of the stock when there is general market risk in the stock or stock market for the matter. Okay, foreign exchange risk is then again it's a volatility in the FX rates, right? And irrespective of how you hedge your foreign currency, there will always be uh, some degree of risk. So because the currency risk will definitely be there. So that is how this foreign exchange risk is there. Foreign exchange risk arises from the open or imperfectly hedged position in particular foreign currency, denominated assets and liabilities, leading to fluctuation profits or values as measured in local currency. So given you are trading in two different currencies, and when you're doing that, there would be a risk arising from the different currencies also. And if the positions are not hedged properly, then that risk will surprise you, and it can really be one which can kill a lot of your money. So that is how foreign exchange risk is there. Commodity risk. The price risk of commodities differ considerably from the interest rate and foreign exchange risk, since most commodities are traded in the market in which the concentration supply is in the hands of few suppliers who can magnify the price volatility, right? So the commodity, like petroleum products and all these are the commodity only. And you talk about all those grains and all are also commodity. So it's been seen when the commodity supply is largely managed by uh, you know few suppliers in the market, and if they make their mind to change that supply and divert their supply to the market where they find good interest rate, or where they find uh, um, good safety cushion for the FX and all, so that commodity risk may arise in the country. So commodity risk can be there when the those suppliers or the traders who have a large stock with them, if they think of diverting their stock or their commodity in a different market for their own interest, then there can be a commodity risk price risk in a given market, right? So that is how the commodity risk price is there. What is credit risk? So these are the same risks which were listed there on the slide where all those risks were listed. So now what we are doing, we're just going through all those risks one by one, right? Credit risk is the risk of an economic loss from the failure of the counterparty to fulfill its contractual obligation, or from the increased risk of defaulting during the term of transaction. Anyone who does not understand credit risk, I am sure by now you should be, because credit risk is one word which we also did in collateral management, right? So that way it would be known to most of you, but still if you're not sure, let me know. Just read this term. Anyone who's not clear with this term, what this statement or is clear?
Yes, sir.
Okay, fair enough.
Yes, sir, clear.
Okay, let's move on. What is liquidity risk now? Okay, so liquidity risk is also very very much talked about concept or very talked about word, especially in these times it is very much talked about. And when I say Fed talking about this taper of talk, all those talks are somewhere surrounding, somewhere related to liquidity risk only. So what is liquidity risk? What comes to your mind when we talk about liquidity risk?
When we cannot liquidate our share, means we cannot sell our share.
Hmm.
There is no buyer for the share. It is liquidated.
Right, right. That's one. Yeah, that's right. When we're not able to offload our position, when we're not able to, uh, sell our position in the market. So this is a liquidity risk. Your position is illiquid or has become illiquid due to market situation, and that is also one of its kind of liquidity risk, right? And what else? Okay, so let me just another is which are given there as in when you need cash, and that could be to roll over it your debt position. So you need cash and you are not able to fund that requirement because your value of the security going down, and you want to fund that cash requirement against the securities, and you're not able to do that, right? So not able to raise enough money. So that is the funding liquidity risks. So what you would say, that is called funding liquidity risk. You're not able to fund your position. And if you're not able to fund, then that would be a problem for the organization or company, right? If company needs money for its working, it as its working capital, and if there is not enough working capital available in the form of cash, then it is going to be a big problem, a big challenge for the company, right? So that's one. Then when you look at from the trading liquidity point of view, you need no you need cash in the form of collateral, or you need other securities in the form of collateral to do your trading, right? And if you don't have enough enough of securities or enough of cash, then probably you will not be able to meet the trading requirement, especially when the trading needs margin. And if you don't have your collateral, that can be either in the security form or it can be in cash form. You do option selling, you do futures, and all these tradings involve margin. And if your position starts going against you and it starts severely impacting you, so then your margin requirement will increase, right? And if your margin requirement increases, so what will happen? Your trading, you would not be able to do more trading. You would have to fund, or you would have to put in a lot of more margin to cover your existing position, right? And if you don't do, then you have a situation where the existing position can be squared off by the clearing house or by the exchange for the matter, right? So there would be challenges in terms of trading also if you don't have enough cash, or if you don't have your enough securities as in the form of collateral. then they, will not be able to meet the requirement, and that would also be kind of a liquidity risk only. And the current talks that we are having about the tapering by the federal government, US Fed, is in the same lines. How? Because what people or big players have done today, they have put in their money in stock market, right? And why they have done? Because they know there is no interest coming from the bond market at the moment. Bond market is almost giving no interest to them. And if you see the bond market is giving good interest, maybe if not good, better interest, right? So a lot of investors or lot of players would pull out their money from the stock market and would like to put their money in the safer instruments like fixed income, which are bonds, right? Where they know there would be a certain interest given by the uh, bond issuer, and that is a more safer instrument. The stock is not a safer instrument where uh, you have some degree of uncertainty. You don't know what profit you're going to make, but that is true. The stock market gives better return, right? But there is a risk also. So risk and reward goes hand in hand. So there are some investors who look at these news where the Fed announces something, or the Fed, says they are going to increase the bond rates and all. So why they do that? They need to do that to keep the inflation under control. So more liquidity at times become a problem, right? And because economy or economics, you can say, uh, does not uh, does not work on just one side. You can't just print money or just pump in liquidity. Pumping in liquidity is very easy for the banks. That's a very easy task. But but that is how markets can't function, or economies can't function. They need to have a balance on different aspects so that the economy can grow, and there could be, there is not a huge misbalance. Yeah, there is not a huge, uh, you know this imbalance, I would say, in the entire functioning of the country. So that is how this Fed tapering of top, which is happening now and then, is actually having some impact on the stock market, as we know. Okay, buying power refers to the amount of trading counterparty can borrow against an asset under stressed market condition, right? So what is buying power? It is called the amount which one party can borrow against the assets, right, against the security. So as we said, so when the conditions are not good or favorable, so the collateral that you can avail against the securities or the assets would also be reduced in its value, and therefore you would not be able to buy the same stock, same collateral which you are able to buy in a normal situation, or rather able to get in a normal situation where the market is not volatile. So if you are having a 70% of the collateral against a security which is rupees 100, so maybe when the market situation is bad, you might be only getting 50 rupees against the same 100 rupees security. So that may happen depending on the situation of the market. So because there would be there the there would be risk and the fear in the market, and because of that fear, the demand of buying those securities will reduce, and because the demand goes down, so the value of a security will automatically go down. So somebody said, from you, it is a supply and demand phenomena. So it is, again, this is a supply and demand phenomena in a sense. Liquidity risk can be higher when the supply and demand decreases in the market. So in that way you can relate it. Liquidity risk is also dependent on, or increases or reduces. You can say liquidity risk increases or reduces depending on the demand and supply in the market. Okay. Okay, coming to legal and regulatory risk. Legal and regulatory risk arises for a whole variety of reasons, and it is closely related to operational risk as well as to reputational risk. Right. So legal risk and regulatory risk, uh, these are two things clubbed in one. Right. So when organizations are not following the laid out process, or there is some deviation from the standard operating procedures, so that may turn out to be a legal issue for the enterprise, and in a sense company has to defend uh, itself in this legal in this legal issue, right? So they need to be compliant to all the legal requirement of a given market, whichever market they operate in. The companies or the enterprises which are working in that market has to uh, you know adhere to those set out guidelines. They cannot overrule them. So 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 if it is, if it is an Indian market, they will have to follow the Indian rules. If they are in the Hong Kong, they're going to follow the Hong Kong rules. If they are in some other country, they're going to follow the same rules. So the rules may change, tax structure may change, various other things may change in different jurisdictions, and companies which are operating in those countries or jurisdictions, they are supposed to follow and abide by those regulations. If they don't do that, then there could be a problem to them. Right? So counterparty might like the legal and regulatory authority to engage in risky transactions. Legal authority risk are classified operation risk under Basel II. In derivatives market, legal risk often only become apparent when counterparty or investor loses money on a transaction, decides to sue the provider firm to avoid meeting its obligation. Right? So if due to any reason, if there is a if there is a, this there is a dispute on a transaction, right? So that will be taken to the legal uh, to legal challenge, and then the firm would be able to find how this is going to impact them. As long as there is no legal case, they are fine. But when there is a legal challenge happen, so then the counterparty or the party has to defend it in the court of law, and that is when company realizes this legal this legal issue, because legal issue or litigations are such which one can continue for years and years, and another, these litigations involve lot of fees, and therefore it becomes a very uh, a uh, massive effort monetarily and otherwise we can say physical effort also. If you are hiring an attorney, so your attorney would be going and advocating your point in the court of law. So that is what the legal risk is all about. Regulatory risk and legal risk both can be clubbed together, because when I say legal risk, it is because there are regulatory structure already defined, a regulatory framework is already given, and you are not well versed with that regulatory requirement, and maybe you're not following that regulatory requirement properly, and therefore if your counterparty may challenge you, or you know uh, may sue you, and if that happens, you're going to bear the legal challenges. So that is how this legal and regulatory risk is placed there. Another aspect of regulative risk is the potential impact of change in tax law on the market value of the position. So yeah, so that is another thing wherein there is certain change in the tax structure of a particular thing. So if you're selling something, you're going to get some money, right? And if there is some change in the text structure, so that text structure may increase your burden, and that way your obligations may increase, and there would be a huge, you know, the huge uh, risk at your end. You may need to put in more money to cover the same transaction which you might not be needed in the first place. But given the change in the text structure, all of a sudden your obligation increases, and you would have to put out more money to cover the same exposure or the risk, same exposure, or the uh, or the same contract or the transaction for that matter. So that is how it is. There is one example of in 1997, there some tax law was changed in UK, and therefore the major investment suffered huge losses. So just one example given out here. Any question as of now, guys? It is all fine. I guess it is simple and straightforward.
Yes, sir.
Yeah. Okay. So now let's move on to what is business risk and strategic risk. Okay. So classic risk for the world of business, such as uncertainty about, right? So what are business risks? Business risks are basically related to business, right? So demand of products, price that can be charged for those products, or cost of producing and delivering products. So all this fall under business risk. Why? Because you are running a business, and it all depends on the market. It depends upon how the consumers react to your product. If the consumers are comfortable buying your product, and then what is the cost involved in manufacturing the product and all, so that would fall under the business risk, right? So that is what the business, and these are just a few examples which I told you. There are many more, right? Business also has to have various other teams which are going to manage the business. One is the operational team, legal team, and various other teams are part of the business which know, right? So that way there are various risks involved in business. So if any of those teams or any of those function, it can be, you know how sophisticated the business that you're doing. If you're in the IT business, for that matter, you're making softwares. So who are making the software? It is the employees who are making the software, right? So it is, talent is also a challenge. It's a risk to the business. If you're not able to retain the talent, if you're not able to hire the talent on the right time, so business can have a significant loss, or you're not able to win the appropriate deal because you don't have enough talent with you to run those deals, or um, to fulfill the expectation of the client on those deals, and you would lose those deal. And if you lose those deal, you're going to lose the business sooner or later. So these, there are various, one can be from the manufacturing point of view. If the demand goes down, that can be due to lockdown, can be due to the customer interest, that can be the inflation, that can be due to the price, the price difference, the price difference available in the market, the various other competitors who are able to provide the same product at a different price. So all these would, you know uh, be categorized under business risk, right? So all what all factors can influence, or can impact the business, that all would call business risk. Okay. Now what is strategic risk? So strategic risk is all about strategies, right? As the word strategic is given there, that basically means strategies. So who makes strategy? For an enterprise, it is the big stakeholders, or big managers in the company or management, right? Directors and all. Executive directors are the one who are responsible for making strategy for the company, and at times those strategies don't materialize on ground, or they don't fall in line as per the expectation, right? So then it would be a failure of the strategies which was envisioned, and therefore, you know, that would be categorized under strategic risk. And the various factors, it is just not about one sided approach you cannot take when you look at the strategic risk. So strategic risk is vis-a-vis your counterparties, or vis-a-vis your competitors in the market. If there are competitors who are able to, who are well, um, who are able to feel the pulse of the customers well in advance and better than you, then you're going to lose the market share. And slowly and gradually, if you not give proper attention to all these aspects of the market, the market share, because the market share is what makes you uh, makes you have a dominant position in the market. So if the market share is lost every time, or slowly or gradually, then there is a possibility wherein you don't have enough grip in the market, and you become sort of an obsolete player in the market, and there are other players who come up with new strategies, new products, and new designs, so that way your strategies are not working on ground, and you would be saying that strategy has got a risk. So the strategies which you are making are risky strategies, or not obsolete strategies in a sense, which are not paying dividends to you and not helping you as an organization. So if you look at in the stock segment only, just to understand the strategic risk, so there are many companies in various sectors. Let's take an example of footwear company. So when you look at the footwear company, what comes to your mind? Which all footwear company you're aware of? Anyone? And especially from the Indian point of view, yeah. Go ahead.
Bata, Khadins.
Yeah, yeah. Bata is the very known name, right?
Yes.
And Bata is not an Indian brand, though we know, but it is listed in India, right? So, and what other Indian brand you know?
Red Chief, sir.
Red Chief, okay. I'm not sure Red Chief is an Indian brand, maybe. And there is another name that is Relaxo, we have heard.
Sri
Yes, sir.
Leather, sir.
Which one?
Sri Leather.
Sri Leather, okay. And Relaxo is also one name, right? So there, so innovation, so competitors and various companies which are there in the market, they need to look at the competitors while they're making their strategies. They would have to look at the competitor strategy. They cannot be privy to all that what the competitors are doing in the boardroom, right? So that information certainly would not be coming, but the way they can understand those strategies is reaching out to their own customer, taking the feedback, what the customer is not liking about the product, and what the customer is liking about the other competitors in the market is something which you can access to, right? Or maybe you as a enterprise has smart people in the business who give lot of attention to all these aspects of the competitors, how they are doing business on ground. Before even the product is launched, or before the product has arrived, you already have a sense of what the product is all about, and therefore you also evolve and you also develop a product of same level which interests the customers on ground, and therefore you don't lose your market share, because this is a competitive world, so you, if you're not ready before your competitor is there, you're going to lose money, and you're going to lose it substantially. Look at the telecom world, very well known. What happened? Geo came with a lot of different strategies for different platform, or different, you can say, different this way of working. Their model of working is quite different than the model of working of the other players in the same segment, and therefore the margin of profit is different, and the margin of profit would be different, and definitely that means you as a player, the other player who has put in substantial amount of money in a one strategy or one business, one kind of business, would be difficult for that player to pull out, or rather not, even if they don't think of pulling out, if they're trying to you think trying to think of using the the surplus money for putting in the same kind of a business which the other competitor is running. So that would take some time, and the same time it would be riskier, because now you cannot leave the existing model. And what happened in case of Geo, it's a very good case study. It's a very good case study to understand how the strategies fail, and how strategies don't work if you're not keeping pace with the times, right? So this is a good example. So Geo model, and how the Geo is able to sustain, and why the other player, especially I'm not talking about Vodafone has its own challenges, and the AGR dues and all those are the bigger ones. But even if you look at Airtel is, it is it is far better placed, right? But still Airtel is having good challenges, as in the very significant challenges, right? So why is it that? Because somewhere the management is not keeping pace with the strategies or with the time, and they are complacent of the fact that they are the the market leaders, they are the sector leaders. No one can just uh, they can be overthrown. No one can overthrow them, right? So that is not no what the situation. Everyone, no one is permanent, no one is indispensable, right? So there are players, or even Geo is a player who, you can say, they have a lot of wealth and money and all those things, but there are now startups also, they can change the market if they have very evolving and innovative ideas, and those things. Even startups have that potential of changing the market very quickly and sharply. So that is how this strategy plays a very pivotal and very vital role in shaping up a company. If the players sitting on the top don't have a vision, and they can't envision those things in a very quick and you know in a very short span of time, they can't convey their people that this is how they're going to take a future direction, or future approach should be in this manner, then it becomes a strategic challenge. So that is how the strategic risk. So strategic risk is very important risk, and that risk is something which sits with the senior stakeholders, or senior directors, or senior management, and therefore, but it impacts everyone. Though it is something which is more managed by the senior people, but it is going to impact everyone, even when you don't have any fault. If I am, let's suppose I am the employee of any company, I'm working with a company, right? So I am not something who can really contribute to the strategies, because my role is not involved in those aspects or in those things. But if there is a strategy risk, it is going to impact everyone. Let's look at the employees of Airtel, or for that matter Vodafone. Are they not at risk? They are at risk, right? So that is how I'm saying the strategy risk is also one of the very significant risk. Okay, any question, guys, as of now? All fines here? Any question, anything not clear, or want to say, or adds any point, any thought you have that you want to add? Maybe you can do that. You feel free to add your point also, if you have some some thought, idea, or some example, you can also add here for the interest of everyone. Okay. Okay, let's move on quickly. Reputational risk. It's the easiest one. Reputational risk can be divided into two main clauses. The enterprise can and will fulfill its promises to counterparties and creditors. Enterprise is a fair dealer and follows ethical practices, right? So reputation risk is where you lose the reputation. It's a very simple word. It's a simple thing. It can be due to various reasons. So the two of them is given there, wherein you're not fulfilling the, to your creditors. That can adversely impact your reputation in the market. So the examples you can take as in, you know, the example is which was this company, DHFL, and and Satyam is also one example. So they did not fulfill their creditors, and therefore it causes a lot of reputation risk to them. And if you are not following the right practices, so then it can become a problem. If you remember BCCI bank, right? So that bank was not a bank in the Europe, did not follow the ethical standards or practices, right? So that bank was later shut down, but it can lead to a lot of reputation risk, even when uh, you know when you are in the function or in the operating mode, then also it can cause a lot of operating risk, and your clients, your counterparties um, may exclude you or may not like to do business with you when you follow unethical practices or when you don't have a good reputation in the market. So reputation the, is the one risk which is the uh, which comes with all other risks also. Every risk that you talk about, if anything goes wrong, all other risks can also lead to the reputation risk. This is one risk which overlaps with every other risk. So if there's an operational risk, it can lead to reputation risk. If there's a credit risk, there can be a risk with the reputation risk. So a reputation risk is the one risk which sort of overlap with other risk also, because it is about the reputation. So you are not able to do anything in the set manner, on the right manner, then it is going to have a reputation risk. Okay. What is systemic risk? Anyone? Anyone has heard this term before? Okay. So, the systemic risk is wherein the risk which is coming from the system. System in a sense, if you talk about, the industries or the market, you very well know all the industries or, the market industries or various enterprises or various businesses or sectors are somewhere interconnected, right? Somewhere interconnected. So if one company fails, it can have a domino effect on the other institutions as well, because as we know, the institutions are fairly interconnected, because one bank is lending to other bank is lending to third bank is lending to fourth bank. So if you look this web of transactions, we can very clearly gauge this is very complex interconnected structure, and if one player fails, it can cause a systemic risk wherein this entire system may fail. So like, if you look at the Lehman Brothers crisis which happened in 2008, and Lehman Brothers was one of the biggest player in the US, and while the US government did not save Lehman Brothers and made it file a bankruptcy, they had to save the all other players, be it AIG or the various other institutions which later came came into light that they were having as severe uh, losses or as severe impact as the Lehman Brothers was having one point in time, right? So systemic risk is this only, wherein the entire system has a threat, and with one company going down, it can have a chain effect. It can cause other players a huge massive problem. So such kind of risk would be called a systemic risk. Okay, now coming to your operational risk. Operational risk is very talked about. Why? Because you would be in the operations only, and therefore you need to be aware about what all operational risk can be there, right? These are very easy to understand, but you need to be having these things in your mind so that you don't struggle to answer them. But the operational risk is very important from the employee point of view, given everyone is going to have a direct interaction with these kind of a risk. So therefore you should be very well versed with the operational risk items. However, the other risks are also impacting employees and the organizations, but you are going to have a direct interaction with these risks, therefore you should be very well aware about them. So what are operational risks? Anyone knows about them?
So operational risk is basically
Hmm. Yeah.
when someone is doing the accounting part or making the entry, they are doing some false.
Right. Right. Correct. Anyone else?
It mostly the clerical error and if any
Yeah.
frauds happening in the inside the organization. So
Okay.
these are the opposite.
Well said. Fine. So okay, so let's see. Look at this slide. You have as in your points mentioned there. Fraud, you said fraud is mentioned there. Human errors, you said accounting errors, right? So that is, so if it is an error, then it will be under the human errors. But if it is a accounting fraud like the Satyam one, so that will go into fraud, right? So that is how you would club them, and then you can say the systems are not efficient or not uh, good enough, right? So inadequate system, and the management failure, faulty controls. As we discussed, the controls are obsolete or redundant. So so these are all potential you know issues which can have an operational risk, right? So these are all the points which will cause the operation risk, right? Then other than this, you can also look at the natural and man-made disaster catastrophes, right? Man-made means natural disaster, that can be hurricane, that can be the earthquake, um, it can be heavy rain, and the man-made catastrophes can be that can be there can be riots in the city, right? And there can be protest and all. So these are also a risk to the operation, right? So if you're not able to reach office on time due to any of these things, or not able to function from work from home also due to any of these situation, so that is a challenge to the operation, and that will club into operation risk, right? So other non-finance risk, operation risk is the oldest and the is both the oldest and the newest threat faced by the financial and non-financial institutions. So it is not, it is just limited to the financial world. Operation risk is something which is common to all the industries, right? Banks have to protect themselves from the key threats to their operations, such as bank robbery and white collar fraud, right? So robbery is also then a man-made catastrophes only, right? So this is also a risk to the operation. So okay, white collar fraud can be termed as a same example that we discussed, where it was a accounting fraud. So it would be considered a white collar fraud, where people knowingly did that fraud to make money. Okay, let's move on. So again, you can divide the operational risk into these terms, or these three terms, which are four terms rather written there. People risk, which can be incompetency of fraud. Process risk, which can be your model risk. Model means your system which calculates the mark to market value. That model is not functioning well, and that is not giving the right valuation. Transaction risk. So transaction risk can be categorized execution error, product complexity, booking error, or the settlement error, all will fall under, or documentation contract risk, and all those things will fall under transaction risk. Operational control, so security risk, volume risk, all this will be going under operation risk. Systems and technology, systems are not working, program is not working, right? So then external event, we discussed about earthquake, hurricane, and all those things will go in the external. So broadly, you can categorize all the operational risk under these four items, and that is how you would see operation risk under these four headers of people and process, then operation control, systems technology, and external events. So these are four items. Okay, so just few more information on the operational risk. So factors causing operational risk: increasing complexity of financial instruments, greater dependency on information system. Okay, lack of familiarity with new financial instrument, misuse of financial instrument, mispricing or ineffective hedging, operational errors in data feeds. So all these will lead to operational risk, right? I am sure you are aware about these terms. Very simple terms I mentioned. The increasing complexity of financial instrument means there are complex transactions happening, especially in the OTC world. You see a lot of complex derivative transactions happen, and the people even don't know about them. They don't have in-depth understanding of the transaction. They just know the high level information. That can become a problem, because when you don't know the transaction, you may end up doing the wrong calculation, or wrong understanding of the product, can lead to a problem, or can lead to operational risk. Misuse of financial instrument, mispricing, that is the model risk that we talked about in the previous slide. Feeds, incorrect feeds are coming, right? And you don't able to make out, are you not able to make out those you know data feed issues, and therefore you end up doing wrong trades on a given day. So all these will be under operation risk. Okay, risk of loss resulting from inadequate or failed internal process, people, system from the external events. This is the definition. And these failures include, failures will be computer breakdowns, deliberate fraud, potential mishaps, errors of judgment, a bug in a key piece of computer software. So these are the errors, or the failures which can happen in operation, right? So this we have partially already done. So how the this operation risk should be managed by the directors or the management in the company is given or listed in the form of principles. So it is just a good to know. As such, it is not something which would be asked there. More questions would be on these front only. So these risks you should be you should be knowing about the various kind of risk in the operation and all, but still you should be knowing, reading them. So it is just a sort of a principle, in a sense, which the executive directors of the company should be following properly in order to avoid the risk. So what is there? You can we can read it. Board of directors should take the lead in establishing a strong risk management culture and ensure its existence throughout the whole organization. Banks should develop, implement, maintain a framework that is fully integrated into banks' overall risk management processes. Board of directors should establish, approve, and review the framework and oversee senior management to ensure the policies, processes, systems are implemented effectively at all decision levels. Board of directors should approve, review a risk appetite and tolerance statement. Board of directors should approve, tolerance statement for operational risk that articulate the nature, types, levels of operational risk the bank is willing to assume. Senior management should develop for approval by the board of directors a clear, effective, robust governance structure with well-defined, transparent, and consistent lines of responsibility. Senior management should ensure the identification, assessment of operation, right? So this is more from the enterprise point of view. So now senior management should ensure there is an approval process for all new products, activities, processes, systems, and fully access operational risk. Senior management should implement a process to regularly monitor operational risk profiles, material exposures, reporting mechanism at the board, senior management, and business line levels. Banks should have a strong control environment that utilizes policies, processes, and systems, appropriate internal controls, and appropriate risk mitigation and transfer strategies. Banks should have business resiliency and continuity plans in place to ensure an ability to operate on an ongoing basis and limit the losses in the event of severe business disruption. Banks' public disclosure should allow stakeholder to assess its approach to operational risk management. So these are, these principle from, from the operational risk point of view should be followed by the management to avoid the operational risk. Okay, so now what's the time right now? 10:30.
10:30.
Okay, one second. Just give me a second. Let me see how many slides are there. Okay, so there are only these are case studies, just an information, good to know information there about Barings Bank, and these probably you can do on your own. There is nothing much to discuss. Just normal case studies are there for your reading only. So few more slides are left, then we will take a break because today's session is only for 3 hours, 9 to 12. Right. So we'll take a 15-minute break and then we'll be doing the stuff that we left yesterday. So let me just finish it because we left with few slides only here. Then we can take a break. Okay. So major banks struggled to control operational risk, nearly 210 billion in operational risk losses since 2011. Just a good to know information, right? So because banks don't have robust operation risk management strategies earlier, and still there are some banks who struggle with this challenge. So there are lot of operational cost or in the form of loss on the trade, loss on the transactions that happens. You would have read news some months back wherein Citibank transferred, one transaction of I think 900 million or something in some incorrect account, and that happened just a few months back or maybe in the last year, if I remember it correctly. So that was one of the operational risk example only. Citibank transferred that money incorrectly to an account. So then they probably have reached out to the bank to recover that amount, but it leads to one operational risk. At the same time, it also leads to reputational risk, because as I said, reputation risk is one risk which usually overlap with the other risk. If you have an issue which becomes a matter of concern in the whole system, or if it is known to the other players, then it will be another reputation risk. So of mitigating operation risk, 4 areas to watch: people, IT, organization structure, regulation. So these are the 4 focus area where it should be focused to mitigate the operation risk. So if we have focus, because these are the 4 areas where we also, when we looked at this slide here, this was talking the same 4 areas. So here also the focus has been given on these 4 areas: this people, IT, External events you can't control, but what you can control is something which where you should focus on, right? So people, IT, organization structure, regulation, all these um, thing which impact the operation should be focused on, so that the operation risk can be mitigated. Problems can arise from, it is bit of an it is bit of the same information that we covered in the previous slide. These things include they can cause damage when they do things wrong, either by accident or on purpose, right? So intentional illegal breaches of policy and rules, sloppy execution, lack of knowledge and training, unclear and sometimes contradictory procedures. So these are very self-explanatory. I don't think I need to explain them. If you don't follow policy, if you do in a sloppy execution, if you don't process a trade properly, knowledge, you don't have enough knowledge about the the product you're working on or the process that you're managing, then it can lead to failures, it can lead to operation risk. So it again, now it is about IT. So given the landscape of leads to these problems of hacking or leakages and all, then your entire data uh, can be can be compromised, and which can leads to operation risk, which can lead to reputation risk, which can lead to various other risks which we just talked about. So one risk can lead to other risk as well, as we discussed. So this is the IT one. Manage structure is setting aggressive sales target, rewarding employees, meeting the aggressive target. So at times the bank or organization has very aggressive targets, so the structure is such, or they keep getting pressure from the management achieving their target, and in that race they forget to follow the right practices. And so one such example is wherein the Wells Fargo Bank, if you go back in 2016 or 15 somewhere, they started making a fake account in the name of their customers. And there were no such customers. They were just using the name of they were getting the SSN number and all those things from somewhere, and they were opening up account many times in the name of same customer. So that happened, and that happened very very rapidly across the organization. And the Wells Fargo really made huge profit in that segment one point in time. And when it came to knowledge, the CEO of the bank refused the those allegations. And later, when the investigation and all investigation was conducted, it was established that all those charges or the allegations were true, and therefore the banks had to pay a lot of penalties and fees for those things, and then the CEO of that time had to step down. So these organizational structural problem can also lead to a lot of issues in the operation, wherein if the structure is not following the ethical practices, or they're not having the right thing in first place. So sort of the code of conduct that we say, the code of conduct is not followed properly, and they just have one target or one thing in their mind of achieving the revenue all the time, right? If they just circle around the revenue, don't circle around the code of conduct and all other things which are also equally important for the bank, then that can lead to other problems, in operational problems that we discussed of the nature, where the bank is exposed, and bank comes to the notice of regulator doing incorrect or malpractices, and therefore regulatory fines and losses would be there. Okay, so then regulations are equally important. So banks and all other players in the financial world, or for that matter even in the non-financial world, have to follow the regulations set forth, and if they don't follow them, then there would be repercussions for that. Right? Then there are the case studies. Barings Bank. Anyone remember? Anyone knows about Barings Bank? What happened with Barings Bank?
No, sir.
No. Okay. So just to give you, there is a one. I'll let you know. There's a movie also available on YouTube. You can go and watch that movie. That is on Barings Bank only. So there was a trader. His name was Nick Leeson. Okay. Nick Leeson was the name of the trader who was one time a clerk in UK. Then he was assigned this project of trading in Asian market. Started with the career with Indonesia, if I'm right. I'm not very sure about the location where he started doing the trading. Then he went to Singapore, I guess. It's given there if you read it here. Barings appointed general manager of a new operation futures market in Singapore international market, right? Barings had held a seat on this sometime. So he started his career from the Singapore market, or rather, I would say some other market. Singapore was the second market where he was given another appointment. What I remember with that movie. So so there he did. He was doing quite a speculative trading, and he made an suspense account, numbered 888. If you see this here, he made a suspense account which he was using to hide his losses on the actual account, and he was covering those losses. He was not something which is making his profit. It is not he was doing it for his own profit, but what he was doing, he was doing quite a lot of speculative trading, and by that he was getting into the good books of the bank. He was he was seen as a trader who was really doing great, right? And he was he was called for presentations on the best practices and all those things for all other traders, right? But he knew he was not doing the good things, and he was having all those all those wrong practices in his process or in his way of operating. He made an a suspense account where he was hiding those losses which he was incurring, and that continued for quite a long time, and he was earning a lot of good bonuses every year, good salary, and compliance team was not having good checks that point in time, and they were not having good reach to him. It was shown in the movie. The one point in time the compliance team reached out to him to know what great he was doing, so that he was making that great profits from that great profits in his in his books. But later his bosses or the senior management protected him, and they gave them that sort of leverage wherein he was able to operate in his own will or in his own way, and by that he was able to escape from all those compliance and controls of risk management team. And that finally led to a problem that there was some external event happened, some earthquake also came, and therefore the market was closed, and he could not cover the position where he was exposed. And given he was not able to cover the position, so the position actually started unraveling thereafter, and it came to know it came to it came to light later that he was having a very huge exposure, and that exposure was equivalent to the amount where the entire bank was bankrupt because of his trading. So you can see this is a very good case study. You can read about it more. And this one particular example actually happened in 90s only, somewhere 90s, 90s, right? 92 is written there, right? So this is one case study where it reflects why the risk management is important. 96 is when the bank happened. Bank was bankrupt because of the one sole trader who did a trading of that huge scale and size, and that trading actually led the entire bank into bankruptcy. So you can see how much importance the risk management has actually has become now, because that point in time back in 90s, or the risk management was not that important. But now with every crisis happening, the risk management is gaining importance, right? So that is how this risk management is. The many more case studies, I leave it for you to read them. and uh, this is just for your understanding. As such, there is no questions would be there, but for your own understanding, you should be knowing them. Okay, so with this, I stop it here. Any questions we can you can ask now, and we'll take a break, and then we'll start at 11. Okay. Any question? Or we good?
Sir, what is the name of that movie?
The name of the movie is Rogue. It's Rogue Trader.
Okay, sir.
Yeah, that movie is Rogue Trader. If you write this, you will be able to get it. Yeah, there on YouTube. And that's a nice interesting one, though that would not be giving you that great detail about his trading and all, but you will get some fair amount of information as to what he was doing. He was into futures and options trading. This guy, this Leeson guy which I'm talking is was into futures and options trading in the Asian market. He was a clerk or some small junior officer in London. Then he was transferred to the Asian markets, and there he earned quite good name, and with that name he had good aspirations, and he wanted to earn quick money, big bonuses and all. And the investment bankers really get huge bonuses, right? So that is how you end up into difficult situation if you continue doing those speculative trading. And the bad thing about previous time was that the control system was not that effective, and that was the only reason why traders were able to do all those things. Nowadays it's not that easy to do. Okay, so with that, let's take a break for 15 minutes, and then we will begin at 11. Okay.
Okay.
Okay. Okay, so um, everyone there, right? Okay, so we have completed our risk management sector, right? So before we jump to the remaining part that we were doing yesterday, and a couple of slides were left. Most of them were covered, right? So few of them were left, and that we will cover now. And you guys have your mock and final test the next coming the coming weekend. So is that a final mock or is that a second mock?
Final mock, sir.
Oh, that's a final mock. Okay. So okay, that's good. Okay, so that will be having everything, right? So level one, level two, and level three also. So all the best, right, from my side, and
Thank you, sir.
then we'll meet maybe uh, because you already have a placement session yesterday, intervention session we had. So and but you would be having subsequent sessions later also because that is when your portal access and everything would be open up, right? And as per the opportunities which would be coming, so you would start looking for those ones and start appearing for the interviews for those opportunities which come your way. Right. So all the best. Do well. And officially, this is in terms of in terms of uh, your uh, training session point of view. This is officially the last session we can say because thereafter you're going to have the mock and the test and all. So that way you can say this is the last class that we're having today, right? So all the best. Do well and keep in touch.
Thank you, sir.
Okay, sir.
Yeah. Welcome. Okay. Let me share my screen. Okay, so we had covered, yesterday about regulation we were doing, right? So for the benefit of everyone who were not there, we covered a couple of regulations that are part of your KYC and the regulatory framework that we have in the certification. So Basel norms are important, right? And then we have what is Dodd-Frank regulation, where all it impacts, where all it has use. That is what we covered yesterday. Then we covered MiFID. MiFID is largely for the European countries, right? And what it impacts, what it covers is what we did yesterday, right? And then FATCA is more from the US market point of view and how it works, what is its utility and all that what we did yesterday. And then we did FATF, then we did FinCEN, OFAC, and now we're going to start with EMIR. So after this, I guess we have got how many slides are there? Let me just check. One, two, three, four, five. So there are close to 5 slides. So I'm sure we would be able to complete it uh, today. In fact, in within time. So yeah, so let us start with the European. Maybe if somebody wants to read it because it's a bit of a reading, I will ask maybe one of you to read it for me. Ajay, maybe you want to read it. This slide. Let me just expand it, maximize it. Yeah, we can continue.
Uh,
Yeah.
EMIR
Hmm.
overview. The European Market Infrastructure Regulation (EMIR) is body of legislation for over-the-counter OTC derivatives,
Yeah.
central counterparties, and trade reposi- repositories.
Hmm.
EMIR was introduced by European Union as implementation of the G20 commitment
Hmm.
to reduce systematic counterparty and operational risk. and increase transparency in the OTC derivative market.
Yeah.
It was also designed as a preventive measure to avoid fallout during possible future financial crisis, similar to the collapse that followed the Lehman Brothers bankruptcy in 2008. It establishes common rules for central counterparties, which interpose themselves between involved parties in a contract to serve as the focal point of each trade. And the trade repository, which collect and maintain all the records of the trades. EMIR requires the reporting of all derivatives, whether OTC or exchange traded, to a trade repository. EMIR covers entities that qualify for derivative contracts in regards to interest rate, equity, foreign exchange, or credit, and commodity derivatives. It also outlines three set of obligations, including the clearing, reporting, and risk mitigation of applicable products. Key aspects: entities that qualify for EMIR must report every derivative contract they enter into a trade repository. They must also implement new risk management standards according to EMIR, including operational process and managing related to their bilateral OTC derivatives.
Yep.
EMIR also cover trades that are not cleared by central counterparty, and entities that qualify must submit all the OTC derivatives subject to mandatory clearing obligations for review. Counterparties must file reports wherever they enter into derivative transactions in the European Economic Area or elsewhere.
Right. So the crux of this regulation is this, right? So this was introduced after the 2008 financial crisis for European countries. In the similar lines, we have a Dodd-Frank in US. So this regulation was more from the OTC derivative markets point of view, right? So it was it was known after this crisis, a derivative played a significant role in uh, in um, causing problem in the financial market, and therefore this particular regulation is more inclined to streamline the derivative market and OTC derivative particularly. So what this regulation talks about, this says, so one, all the derivative, right, all the derivative trades, be it the OTC derivative or the exchange traded derivative, should be reported to the trade repository so that there is enough record available for all the trades which are happening, and regulators can directly access to those trades in the case of their requirement. They can have a very direct access to those trade data and everything. That's the one thing which is given there. Then they also proposed to have a central counterparty. Central counterparty was just like an exchange. So earlier the trading which was happening in the OTC world was a more of a bilateral trading where two counterparties sit on a table, negotiate the contract and do the trading. But the EMI body also, as a regulation, proposed a central counterparty which would act as an exchange for all those OTC contracts, and there all those provisions of initial margin and everything would be applicable as it is like it happens on the normal exchange. But as you know, derivative market is a complex market. It's not that easy to bring everything on exchange, because bringing everything in exchange means a cost, and to bear that cost you need to have enough liquidity and volume on the exchange. Therefore there was apprehensions and concerns raised by the various OTC derivative players that it would not be possible to bring everything on exchange. And therefore what they said, if you look at here this line which is given there, EMI covers entities that qualify derivative contracts in regards to, not this one. Uh, they must also implement, there was one line which I read. Yeah, this one. If you read this one, in key aspect, EMI also covers trades that are not cleared by central counterparty, and entities that qualify must submit all OTC derivatives subject to mandatory clearing obligation for review. So where, when the OTC derivative trades are not clearing through the central counterparty, then they should have more liquidity, more cash, surplus cash available with them to avoid the future fallout of the same nature which happened in 2008, right? So that was the idea of the EMI regulation. And with this regulation, the objective which it was trying to achieve was to avoid or reduce or mitigate the systemic risk which sort of happened in back in 2008 with the collapse of Lehman Brothers and various other financial institutions came into crisis, right? So that is what the intent was with the help of this regulation. It was to cover for the European market only, but to reduce the impact or reduce the reduce this kind of crisis or not allow or not have a scope for this kind of a crisis in future. So this regulation was brought in Europe. Okay. So this is an extension to what we just did from the clearing point of view. Maybe somebody else can read it. About Akash, maybe you want to read it now?
Okay, sir.
Yeah, go ahead.
Clearing. The European Security and Market Authority applies mandatory clearing obligation for specific OTC derivative contracts. If a contract has been assigned a central counterparty under EMIR, the obligations require that over-the-counter derivative trades are cleared through central counterparties. EMIR granted a temporary exemption from these guidelines to pension funds until August 2017. All parties involved in trade must submit timely notification of approaching, exceeding, and no longer exceeding the clearing threshold as defined by EMIR. This clearing regulations applies to financial counterparties such as banks, insurers, and managers of assets, as well as non-financial counterparties. Reporting. EMIR requires that entity, all entities entering into derivative contract must submit report to their corresponding trade repositories outlining each over-the-counter trade. These
Hmm.
mandatory reports must also include a unique transactions identifier, legal entity identifier, information on the trading capacity of the counterparty, and the mark-to-market valuation of the position. The counterparty data is a report includes 26 fields for data, and the common data include 59 fields of data. These fields include an LEI or a unique 20-digit alphanumerical code that may be used for 8 of the 26 counterparty data fields and the unique trade identifier, which is generated based on the report LEI. Block trades, which are large-scale transactions of shares, and any subsequent allocation must be reported to the fund manager. If the block trade is associated to the manager individual fund on the trade date, only the allocation need to be reported. In the event that the block trade is not allocated on the trade date, the block itself must be reported with the fund manager as counterparty.
Yeah. So what this, what this slide talks about, it's an extension of the previous slide. So here, when we do the trade reporting to the trade repositories, so trade repositories are known organizations like DTCC. DTCC is a very known, it's like Euroclear and Clearstream. These are the clearing, clearing a settlement or a custodian player in the OTC market and also for the exchange market. Similarly, DTC also plays the similar kind of a role. They also have other things in their kitty. So DTC also has a trade repository role to play in the OTC world. So what they do, they ask all the players to report their trades with the legal identifier. So there would be a legal identifier. You do not need to go into nitty-gritties, 59 fields and 26 fields. That's fine. You just need to remember the legal identifier basically gives an identification of the counterparties or the parties involved in the trade. So that information would be shared with the trade repository so that it can be determined or it can be no it can be established which counterparty is that. So especially when the regulators need that data, they would need to know which counterparty's valuation is updated or is reported with the help of this particular data. So therefore, the LEI information is necessary. That is legal identify information is necessary when it is reported on the trade repositories. Trade repositories are just certain bodies like DTCC is one of them, right? So DTCT, what it does, it is also involved in custodian and settlement business. Along with that, they also do this trade depository function. So usually these players have a lot of other responsibility, other businesses also, other than the core operation, core role of the settlement and clearing. So that's one. And then they also said about how the clearing should happen. So clearing of this OTC derivative will subject to, subject to one, through the central counterparty. If they don't have a central counterparty due to complexity of the product or all those things, if they're not able to go on central counterparty platform, then they need to have enough funds available or enough cash available or security available to mitigate the future exposure. So that was the second thing was talked about in this clearing thing only, right? And so these are two main thing. About the block trade is something wherein it is for mutual funds only, the where if they are going for buy side firm, it was more important block trades thing. So if your block trades means when they are executing a large transaction, later what they do, when the transaction is executed, that they spread those transactions into different portfolios. So there can be a thing wherein they are doing a 5,000 trade, 5,000 uh, 5,000 shares are being bought by them at one go, and those 5,000 shares are not meant for only one portfolio, that is meant for 10 different portfolios. So they spread those shares in different portfolios later. So that kind of a transaction is considered to be block trade. So how that should be reported is what is given there. So as such, for the fund manager, it was not necessary to report that block trade transaction if it is not allocated in the portfolio on the trade date. So that is what was given under the email. But as such, the important thing to remember for you is these 3 points you need to remember. 3 points, if you remember, probably you would be having enough information to cover the EMI. That is, one is all the OTC derivative parties, OTC derivative contracts were said to have central counterparty. If not, if they can't have due to complexity of the products and all, then they were supposed to have enough, cash or surplus available to mitigate the future risk or exposure which they may foresee in future. That was the first thing. Then second is a trade repository. All derivative trade, be it the exchange traded derivative or other derivative trades, should be reported to trade repository of the kind of DTC. So this should be reported. So these two things or other three things I would do, because the uncleared one would also be when when the trade cannot be cleared through the central clearing party, they need to have more surplus cash available with them. So these 3 points you need to keep in mind. Okay. Any doubt, anything not clear, let me know. Okay, so let's move on. Okay, let's move on to the next slide. Maybe Chunky, if you want to read this one. Chunky, if you're speaking, maybe you're mute. You need to unmute yourself. Looks he's not there. Okay, maybe Deepak, you can read it. This slide. Am I audible?
Yes, sir.
Okay, I thought maybe there's some issue. So Deepak is not there. Okay, maybe I don't know. So, Jyotishana, maybe you can read now this slide, this one.
Yes, sir.
Yeah, you can read this one.
The Bank Secrecy Act BSA 1970, also known as Currency and Foreign Transaction Reporting Act. The BSA was the first landmark legislation formed to prevent criminal for obscuring the origins of criminal proceed through banks and other financial institutions. The law compelled financial institutions to cooperate with the government against suspected money laundering. The legislation also rapidly became a tool for tracking and intercepting terrorist funding. Still very active today, the BSA seeks to identify and track the movement of money and other instrument in and out of the US and between financial institutions, and therefore requires record keeping and reporting for individual or financial institutions. Bank must submit a currency transactions report CTR for all cash transactions of more than 10,000
Yeah,
dollars, a threshold amount that has remained unchanged since 1970 in the transactions. Additional banks must identify and document the individual and institutions involved in this transaction. The Money Laundering Control Act 1986. The Money Laundering Control Act 1986 made money laundering a federal crime and aimed to encourage foreign corporations toward eradicating the drug trade. Additionally, the law set reporting requirement for payment of transmission of more than $10,000, not limited to cash transaction, stiff penalties and forfeitures provision as a result of his law of this law. Assets in case of BSA violations became vulnerable to civil forfeits forfeitures, meaning they could be seized whether or not anyone was charged with a crime. The law also compelled bank to follow and maintain BSA reporting and record keeping requirement.
yeah. So you, if we see the landscape of the banking landscape, when we look at, we will see after 1970, lot of laws were made to prevent the money laundering, right? And it was started with money laundering and this combating of terror financing and everything. Actually started from this first act, that is Bank Secrecy Act in USA, right? And then it continued evolving with the one after the another law coming. So in these couple of slides, you've got few laws which came one after the other. So it is given the sequence only. So first is the Bank Secrecy Act. So what it was for? It was for the money laundering only, to keep the transactions, to keep an eye to all the transactions which were happening. And they also came up with a threshold of $10,000, right? And banks were asked to submit a report that was called CTR report. CTR stands for transaction currency transaction report. So if there is a transaction of more than $10,000, so and if there is any suspicion around the transaction, so the authorities can have a proper view of those transactions, carry out carry out their investigation. So that was the aim and objective of this given law, 1970 when it was made, and still till date, this $10,000 limit is still maintained. So that is how this is. So wherein the idea of this law is to prevent money laundering, right, and to combat terror financing and all. But this was the beginning. So how this started up, and then there were a lot of changes, and some tweak here and there happened. So then 1986 another law came which was focused on eradicating the drug mafia also, right, and drug menace. So here they also increases the threshold not only to the cash side, they also made it to any transaction. So that could be related to the payments of normal transactions. So if that transaction is a suspicious transaction where there are chances of you know being having some kind of uh, drug element included, or all those things are there, so that transaction could also be investigated. So that was the case with this particular act of 1986, right? And so this is just on a it's in a very simplified version it is given there. So if you look at the laws, they are really very big ones, but here we are not going into detail, we're just looking them very in a very simplified version, just to have a crux of that. Record keeping is something which was talked about under this. So record keeping was not a very very popular phenomena back then, but after having this Bank Secrecy Act and the subsequent laws which came, or subsequent act which came, actually focused on the record keeping more. So all the transactions should be having a record keeping for certain number of years, so that if there is any any issue or suspicion, that can be even tracked back in the history, and that can be investigated accordingly. So that was the case with these law which came one after another. So moving on to the next one. Any question as of now? All fine?
Yes, sir.
Okay. Moving on. Okay, so there we have a couple of them, and these are as in the a few which came after this one, which came in 1986, after this 88, 92, 94, and 98, and then 2001. So there was as in some tweak in all of these, because if you look at all these laws, they were more focused on around money laundering only. So maybe I'll ask one of you to read it quickly. Maybe Manish, if you want to read it.
Hello.
Yeah, go ahead, Manish.
Sure. Anti-Drug Abuse Act 1988. The Anti-Drug Abuse Act of 1988 was enacted as part of the U.S. So-called war on drugs. The act amended the Bank Secrecy Act in extending the definition of financial institution to include auto dealers and the real estate entities who were thereafter required to disclose the transaction of large sums. Additionally, verification of identity is required for anyone using monetary instruments that have a value of more than $3,000.
Yeah.
The Anazio Valley Anti-Money Laundering Act 1992, as a response to a large international bank being a hotbed for money laundering, the Anunzioville Anti-Money Laundering Act of the 1992, the Act raised the stake for banks. The Act increased penalties for financial entities found guilty of money laundering and encouraging oversight agencies to consider revoking the charters of any financial institution involved in money laundering. It also instituted verification and record keep transfers. In addition, it withdraw criminal referral form and introduced suspicious activity reports, a tool for banks to report any activity they deem suspicious or out of the ordinary. Furthermore, the Act established the Bank Secrecy Advisory Group, comprising of publicly nominated financial institutions, non-federal regulators, law enforcement agencies, and trade groups. The BSAAG is chaired by the directors of FinCEN, who advises the Treasury Secretary on BSA operational matters. The Money Laundering Suppression Act 1994 focused on encouraging banks to improve AML training, develop anti-money laundering examination procedures, and improve procedures for reporting suspicious activity to law enforcement. It also required each money service business to be registered by an owner or controlling person of the MSB and makes operating an unregistered BSB a federal crime. BSB include any individual whether or not on a regular basis that deal in currency, cashes, checks, or issues or cashless travelers check for money orders, as well as the United States Postal Service. The Money Laundering and the Financial Crime Strategy Act 1998, impacting both banking and government agencies, the Money Laundering and Financial Crime Strategy Act of 1998 required the Treasury and other agencies to develop the national money laundering strategy as well as AML training for examiners. Part of this effort included identifying geographic and industry sector at high risk for money laundering and leveraging the newly created high intensity money laundering and related financial crime area task force to structure law enforcement efforts in high risk areas. The uniting and strengthening appropriate tools required to intercept and obstruct terrorism Act USAPAT RIOT Act 2001 precipitated by the 9/11 terrorist attack Title 3 of the USA Patriot Act is referred to as the International Money Laundering Abatement and Financial Anti-Terrorism Act of 2001. For the act of one of its primary purpose is to increase the strength of the United States measures to prevent, detect, and prosecute international money laundering and financial of terrorism. It criminalized terrorism financing, increased civil and criminal penalties for money laundering, and expanded the requirements for anti-money laundering programs and customer due diligence process to all financial institutions.
Yeah. So if we look at here, we see we see 5 laws which were enacted after 19 this after this 86 one, which we saw in the previous slide, right? So the first one you see is the Anti-Drug Abuse Act, which came in 1988. So the idea was to even bring other entities under under the umbrella of surveillance of this financial transaction. So which included auto dealers and real estate entities, and it was found they were also doing some shady deals and shady transactions. So to include the transactions which were done under the name of auto dealers or real estate, they were also they were to be scrutinized or having a sort of a supervision. So then even here under this particular act, transaction carried out with the amount of $3,000 were were, were under review. Were under review, right? So this is just to give me 1 second. Okay. So this was to to eradicate the drug menace from the one from the country, and at the same time under the garb of drug activities there were other illegal activities were also carried out, which were to promote the terror and to promote the money laundering things. So therefore, this was these two entities were also added under the reporting of financial transactions under this Act of 1988, Anti-Drug Abuse Act. So the one was the drug was the one thing, because the war on drug, as it is mentioned, there was the fundamental idea when this act was enacted. But other than this, because under the garb of um, these transactions which are carried out in the name of auto dealers and real estate, there are some shoddy deals happen, right? So to avoid those deals, it was made mandatory to report even the transaction of $3,000 to verify the identity of those people who were involved in these transactions and all. So that was the first one. Then an INSEO Valley Anti-Money Laundering Act, which came in 1992. So what this act was all about, this was more from the financial banks point of view, or financial, companies point of view. So they were they were made to follow money laundering, anti-money laundering practices stringently, and if they were found to be not following, there were some penalties imposed on them. So from there it was started. This penalty things on the banks and everything was started with this act, and they were supposed to also file a report that was called suspicious activity report. If banks find anything suspicious, they were supposed to file this report, and it was to be sent to the authorities who would be looking into this report, and they also deem them suspicious, and accordingly they could take appropriate step to interrogate, to investigate, and all those things was under yeah, under the under the watch of the body. So it was again the FinCEN was the director. It was directly going to the FinCEN law that we studied yesterday. The FinCEN director was the advisory chairman of this BSAG body. So he was the one who was actually looking into these transactions and the report and everything. And if he finds anything wrong, then he accordingly can take the appropriate action on the involved parties in such transactions. Right, so that's another. Then the 1994 suppression, money laundering suppression. Here the emphasis was given on the training part. Right, so encouraging banks to improve the AML training, develop anti-money laundering examination, and also cover businesses which are dealing into money businesses, which as in the who are involved into fund transfer businesses, or who are issuing travelers check, or other currencies. If they're dealing to all these things, then they were to be registered. If they're not registered and carrying out all these things, then there would be stiff penalties on them. Right? If any unregistered money services business is there, then there would be penalties imposed on them. So that was the objective of this particular law, which came in 1994. So one was the focus was on the training aspect, also to have a strong training for the banks, the financial institutions, so that they can understand the criticality of the money laundering and all those aspects. At the same time, all those institution or entities dealing into the financial matter, or the money services business, as we say, as it is written there. So they were to be registered. If they are not registered, they can be, if they're not registered, that would be considered a federal crime, and accordingly the authorities would be taking appropriate action on them. That was under 1994 Money Laundering Suppression Act. Then we had this Money Laundering Financial Crime Strategy Act of 1998. Here the emphasis was given on the training of the examiner, right? So one was the training of the financial institutions and the bank employee and all who are actually involved involved in the financial business, and they should have a very smart eye to detect crimes of this nature. At the same time, there should be there should be a the well organized, managed training for the examiners that was felt after after this act, and therefore the examiners training was given the equal importance under this act. And at the same time, they were also to look after. There was another thing which was mentioned, to look. They need to give more focus to the areas which are high risk areas in terms of money laundering, and the basis there, they need to devise more law enforcement, the more structured law enforcement efforts should be devised to curb the money laundering practices happening on those high risk areas. So that was the focus of this particular act, which came in 1998. Then there was a law which came in 2001, that is also called, this came after 9/11. 9/11, we all know, it's very known, terrorist attack which happened in US. After this, there were these. This was on, on the money laundering only. Money laundering and terror finance was the focus under this law. And then the KYC was made as a mandatory thing for all the financial institutions. KYC one point in time, if you look at here, all these laws were not focused on the KYC much. It is just more on the AML side we are talking. AML and this terror financing is something the focus of these laws. But when this 2001 act came, it increased the punishment on the on increase the criminal penalties or punishment if in case people found to be involved in the money laundering activities. That's the one thing. Then another is the institution was supposed to do the enough due diligence. So if you look at the other slide, you will find it here. Under this law, when the separate financial institutions attempt to combine, federal banking agencies must review their AML record for the compliance and factor in the previous violations and subsequent remediation into their decision on approval or denial of the merger or acquisition. In addition to prohibiting the financial institution from engaging with the foreign solvents, it is also encouraged enhanced information sharing among government and financial institutions, and demanded that banks respond to regulatory requests within 24 hours, within 120 hours. And on particular note, the Patriot Act required financial institutions to implement customer identification program, often referred to as Know Your Customer. These programs must verify customer identity, maintain those records, and ensure they are not on any known terrorist list. So, as we discussed, the KYC became a norm under this act. So, every financial institution who was opening the bank account for their customer, they were supposed to do a strong KYC for their customer, and there should be a strong record keeping. That record should be maintained with the bank. That's one thing. And then other than this, the if the financial institutions are going to be merged, so there they were supposed to be following all the required compliance and all AML requirement, and all those things should be followed, and appropriate approval would be given only when when they are in compliance with all those requirements that's written there. And then if in case any government agency is needing, right, is any government agency is in need of any information from the banks or the financial institution, then they were to supply that information within 120 hours. That was the norm under this act. So this was quite a strong act which came after 9/11, wherein the money laundering became quite a big focus, and it became a very severe crime under this act. Though it was a crime earlier also, but here the punishment increased, and it actually became a very strong focus for the authorities in US. Because if you look at these laws, these are from the US point of view. The US point of view, these laws are there, right? So that is how this 2001 law is there. Then the 2004 one, and this is the last slide we have. So these two are the last laws which we have from the US point of view. So this one, Intelligence Reforms and Terrorism Prevention Act of 2004, amended the BSA to allow Treasury Secretary to require financial institution to report cross-border electronic transmittals of funds if Secretary determines such reporting is reasonably necessary to aid in the fight against money laundering and terrorist financing. So here the cross-border transactions were also under the focus of investigation, or under the reporting, you can say. So under this law, it was made uh, such that if the Treasury Secretary of BSA wants the cross-border transactions to be reported to him, so that transaction would be reported with this law. So earlier the focus was more internally, but here even the cross-border transactions which are happening across cross-border, right? So one country to another country, those transactions would also be reported, reported to him with law, right? So financial institutions were bound to report such transaction in case the secretary, treasury secretary, wants to investigate or look into those transactions. So that became another law. Then the last one that we have for today is FinCEN customer due diligence requirement for financial institutions, and it uh, enacted in 2018. So what it talks about: in 2016, FinCEN introduced, and in 2018 enacted the CDD rule, which amended BSA regulation, namely Patriot Act KYC mandate, to clarify and bolster financial institutions customer due diligence requirement. According to FinCEN CDD rule, financial institution must abide the four requirements: identify, verify, and verify. Uh, Identify and verify the customers, identify, verify the identity of beneficial owners, right? And any individual who owns 25% or more of the legal entity, and an individual who controls, manages, direct the legal entity customers. Determine the nature, purpose of the customer relationship to develop risk profile. Conduct ongoing monitoring to identify suspicious transactions, and on a risk basis maintain and update the customer information. So the beneficial owner thing that you read in KYC AML chapter actually enacted in 2018. So what it says: so any party which owns a 25% stake in an organization, that person would be the beneficial owner of the account, and he would own the responsibility of any any uh, as in he would be owning the responsibility of the transactions happening in the account. So if any misconduct or malpractice happens with on his account by other people, because at times beneficial owners directly do not supervise their account activity. They assign other people to their account, and they carry out those transactions. So there it was made it mandatory that beneficial owner would be accountable if something goes wrong with the transactions and the activities happening in the account. So beneficial owner would be held responsible for that. So that is how it was made. And risk profile was to be developed for all the customers depending on the business they are doing or depending on the profile they have. So if there is a there can be customer who are high who are in the high risk profiles. If that is the case, they are going to have enhanced due diligence as been covered in KYC process. So that is what another thing introduced. And then the ongoing monitoring of the transactions was the focus of this law. And then the record keeping as it is was there. So these things were the focus or the highlight of this given act, which came in 2000 act. So this covered broadly, one, the beneficial owner. Then the risk profile was uh, uh, was developed under this law. Then the ongoing monitoring of the suspicious transaction was the agenda of this particular law. So with this, we wrap it up. Okay. So we have completed your regulatory chapter, which includes the regulation and the risk management. Any questions before we, as in, we are also as in completed on time. We just 3 minutes left now. So any question we can now take, and we are now good with all the three levels. We have completed your level 1, level 2, and level 3. And this regulatory part is going to be a bit tricky because it is more content oriented, more uh, theory oriented, because you need to read about these law, remember this information, keep this in your mind. So it's going to be it's going to take couple of reading, and that is how you're going to be comfortable with this. Okay, so I now open it for you. Any question you can ask. Let me say. Let me also open your attendance data. Okay, let me quickly take your attendance. I'll share my screen so that you can see. 1 second. Okay, so Amit is there. Amit is not there, right? Akash is there. Shivani is not there. Paras is there, right? And Paras I can't see. So 1 second. Jyotishina is there. Manish is there, right? Shivam is there. Nishant is there. Sana is there. Rahul is there. Ajay is there. Shreya is there. Chunky is there. Rashi is not there. Deepak is there. Vashwat is not there, right? Vashwat I didn't see. Siddharth is there. 1 second. No, Siddharth is not there. Okay, so let me just call out your names again. So people who are present, I'll just call out their name only. Akash, then Jyotishina, then Manish, Shivam, Nishan, Sana, Rahul, Ajay, Shreya, Chunky, and Deepak. So these are present in today's class. So anyone whose name I didn't call out. So okay, fine. So guys, anything before we close? Good to close now? Okay, so I wish you all the best because you have your mock and the final test the next weekend. So all the best, do well, and take care.
Thank you, sir.
Thank
Thank
you,
you,
sir.
sir.
Thank you, sir.
Okay, welcome. Bye bye.